Boost your credit score, understanding its importance and improvement strategies. Understanding your credit score is the cornerstone of financial freedom. This three-digit number is more than just a figure. It's a reflection of your financial habits and reliability. It serves as a key to unlocking better interest rates, qualifying for loans, and achieving your financial dreams. The 5 key factors that determine your credit score include your payment history, credit utilization, length of credit history, new credit, and credit mix. Each of these plays a unique role in the calculation of your score, influencing lenders' perception of your creditworthiness and financial stability. Paying bills on time is non-negotiable for maintaining a healthy credit score. This habit accounts for a significant portion of your score, demonstrating to lenders that you are a reliable borrower. Timely payments can prevent costly fees and keep your credit score from taking unnecessary hits. Credit utilization, how much of your available credit you're using, significantly impacts your credit score. Keeping this ratio low, ideally below 30%, showcases your ability to manage credit responsibly. This discipline not only boosts your score, but also appeals to potential lenders, opening doors to better borrowing terms. The length of your credit history gives lenders a glimpse into your financial behavior over time. A longer credit history can contribute positively to your credit score, offering a more comprehensive view of your financial habits. It underscores the importance of starting your credit journey early and managing credit wisely from the start. Navigating the world of new credit involves understanding the impact of hard inquiries on your score. Each time you apply for credit, a hard inquiry is recorded, temporarily lowering your score. It's crucial to apply wisely, spacing out applications to minimize the impact on your overall credit health. Paying attention to your credit mix can significantly boost your score. Lenders like to see a variety of credit types, such as installment loans and revolving credit accounts. Demonstrating your ability to manage different types of credit responsibly shows lenders you're a low-risk borrower, potentially leading to a higher score. Regularly checking your credit report is a protective measure for your score. It allows you to catch inaccuracies or fraudulent activities early on. By identifying and addressing these issues promptly, you maintain the health of your credit score, ensuring it accurately reflects your credit behavior. Disputing errors on your credit report is a necessary step in maintaining a healthy score. Errors can unfairly lower your score, affecting your ability to secure loans or favorable interest rates. A step-by-step approach involves reviewing your report, gathering evidence, and formally disputing inaccuracies with the credit bureaus. High-interest debt can be a heavy burden, making it crucial to employ strategies for paying it down quickly. Tackling debts with the highest interest rates first reduces the amount of money spent on interest, freeing up resources to pay down other debts more efficiently and improving your overall financial standing. Setting up automatic bill payments is a simple yet effective strategy to ensure you never miss a payment date. By doing so, you not only save time, but also safeguard your credit score from the negative impacts of late payments. This method shows creditors your reliability, gradually enhancing your creditworthiness. Responsibly increasing your credit limit can have a positive effect on your credit score by improving your credit utilization ratio. However, it's crucial to request higher limits only if you're confident in your spending discipline. Higher limits should not encourage increased spending, but rather serve to strengthen your financial standing. Shopping for credit wisely is essential to maintaining a healthy credit score. When searching for new credit opportunities, aim for those that require a soft inquiry rather than a hard one, which can temporarily lower your score. Understanding the criteria and pre-qualifying can minimize unnecessary applications and protect your credit health. For beginners, building credit from scratch can seem daunting. Starting with a secured credit card or becoming an authorized user on a family member's account can be effective first steps. These methods allow for the building of a credit history in a controlled environment, paving the way for future financial opportunities. Rebuilding your credit score requires patience and consistent effort. It involves scrutinizing your credit report for inaccuracies, making timely payments, and reducing outstanding debts. This roadmap to recovery might also include seeking professional advice to tailor a strategy that fits your unique financial situation, ensuring a gradual return to creditworthiness. The impact of personal loans on your credit score can be twofold. Initially, applying for a loan may cause a small dip due to the hard inquiry on your credit report. However, responsibly managing the loan by making timely payments can significantly enhance your creditworthiness over time. This positive repayment history demonstrates to lenders your reliability as a borrower. Credit card balance transfers, often seen as a strategy to manage debt, can influence your credit score in various ways. If executed wisely, transferring high-interest balances to a card with lower interest rates can help you pay down debt faster, thereby improving your credit score. However, the initial hard inquiry and the potential for increased utilization on a single card can temporarily lower your score. Closing old credit accounts is a move that requires careful consideration. These accounts contribute to your credit history length, which makes up a significant part of your credit score. Shutting them down can shorten your credit history, potentially reducing your credit score. It's crucial to weigh the benefits of simplifying your finances against the possible impact on your credit history. Co-signing loans is often a generous offer to help someone else secure financing, but it comes with risks to your credit score. As a co-signer, you're equally responsible for the loan. If the primary borrower fails to make payments, your credit score could suffer significantly. This shared responsibility means any missteps directly affect your financial health. The effect of bankruptcy on your credit score is substantial and long-lasting. Filing for bankruptcy can cause your score to plummet, and the mark remains on your credit report for 7 to 10 years. Despite this, recovery is possible. With disciplined financial habits and a focus on rebuilding credit, individuals can gradually restore their creditworthiness over time. Managing your credit utilization effectively is paramount for a healthy credit score. It's the ratio of your credit card balances to your limits. Keeping this ratio below 30% signals to lenders that you're using credit responsibly. This disciplined approach not only boosts your score, but also demonstrates financial stability. Debt consolidation can serve as a strategic tool in enhancing your credit score. By combining multiple debts into a single payment, you simplify your finances and potentially lower interest rates. This method can lead to quicker debt repayment and a reduction in credit utilization, both of which positively affect your credit score. Secured credit cards offer a viable path to building or rebuilding credit. By providing a security deposit as collateral, you receive a credit limit. Timely payments and responsible use of this card help establish a positive credit history, gradually improving your credit score and proving to lenders your creditworthiness. Navigating the do's and don'ts of credit improvement requires patience and knowledge. Do pay bills on time, keep credit utilization low, and check your credit report regularly for errors. Don't close old credit accounts hastily or apply for new credit too frequently. These practices ensure a steady, positive growth in your credit score. Understanding the time frame for credit score improvement is crucial for setting realistic expectations. Credit repair is not an overnight process. It takes consistent effort and smart financial decisions over months, even years. Patience and persistence in adhering to credit best practices are key to gradually elevating your credit score and maintaining financial health. Diversifying your credit is advantageous for demonstrating to lenders that you can manage different types of credit responsibly. This variety, including revolving and installment credit, enriches your credit profile. It shows potential lenders your capability to handle multiple credit agreements, making you a less risky candidate for future credit. Your credit score and the interest rates you are offered are closely linked. A higher credit score often leads to lower interest rates on loans and credit cards, which can save you significant amounts of money over time. This benefit underscores the importance of maintaining a strong credit profile. Having a high credit score goes beyond just qualifying for loans or credit cards. It can lead to substantial savings. Lower interest rates, better insurance rates, and waived security deposits are just a few of the financial perks. These savings can then be redirected towards investments or emergency funds, maximizing your financial health. Ignoring your credit score can have dire consequences. It may result in higher interest rates, loan denials, or the need for a cosigner. This negligence can cost you thousands over time and hinder your ability to achieve financial milestones, such as buying a home or a car. Credit myths often mislead individuals about what affects their scores. Common misconceptions include the belief that checking your credit harms your score, or that you only have one credit score. Dispelling these myths is crucial for accurate credit management and improvement, ensuring you take the right steps towards a healthier financial future. Planning your finances with credit improvement in mind is a strategic approach that can lead to significant financial benefits. By focusing on actions that boost your credit score, such as timely payments and debt reduction, you position yourself for more favorable loan terms, which translates into lower interest rates and savings over time. Financial advisors play a crucial role in helping individuals navigate the complex landscape of credit score improvement. Their expertise can provide personalized strategies that align with your financial goals, helping you to make informed decisions that positively impact your credit score and ultimately your financial health. Marriage can bring about changes to your credit score, although indirectly. While individual credit scores remain separate, joint accounts and loans are reported on both partners' credit histories. Responsible management of these shared finances can strengthen both parties' credit scores, whereas mismanagement can negatively affect them. A credit freeze is a powerful tool for protecting your credit score from identity theft and fraud. By restricting access to your credit report, it prevents new credit accounts from being opened in your name without your explicit consent. It's a proactive measure that can offer peace of mind in an era of increasing digital vulnerabilities. Student loans can significantly influence your credit score, both positively and negatively. Regular on-time payments can build a strong credit history, demonstrating financial responsibility to lenders. Conversely, missed payments or defaulting on student loans can severely damage your credit score, making it difficult to secure favorable credit terms in the future. Understanding the distinction between a credit score and a credit report is crucial for financial health. While a credit score quantifies creditworthiness through a numerical value, a credit report provides a detailed account of credit history, including loans, late payments, and credit inquiries. Both are vital in assessing financial stability. Making only the minimum payments on debts can have long-lasting negative impacts. It prolongs the debt repayment period and accumulates more interest, ultimately costing more in the long run. This practice can signal to lenders a potential struggle with managing debts, potentially affecting future creditworthiness. Negotiating lower interest rates with creditors can significantly ease the financial burden. Lower rates mean less money spent on interest, allowing more of the payment to go towards the principal balance. This not only accelerates debt repayment but can also improve credit scores by reducing credit utilization ratios. The power of good credit extends beyond mere borrowing advantages. It can influence life's major purchases, such as homes or cars, by offering access to lower interest rates and better loan terms. Good credit can also impact job opportunities and rental agreements, making it a pivotal aspect of financial well-being. Staying motivated during the journey to improve one's credit score is paramount. It's a process that requires patience, discipline, and consistent effort. Celebrating small victories, setting realistic goals, and keeping the bigger picture in mind can help maintain focus and motivation on the path to achieving a healthier financial future. Boost your credit score. Essential tips and factors you need to know. Understanding credit scores is essential for financial health. These 3-digit numbers measure your creditworthiness, affecting your ability to borrow money. Lenders, landlords, and even some employers look at your credit score to decide how risky you are as a borrower or tenant. Your credit score significantly influences loan interest rates and approval odds. A high score can unlock lower interest rates, saving you money over the life of a loan. Conversely, a low score may lead to higher rates or outright rejection, making borrowing more expensive or even unattainable. When it comes to renting an apartment or buying a home, your credit score plays a pivotal role. Landlords and mortgage lenders scrutinize your score to gauge your reliability in paying rent or a mortgage on time. A low score can limit your housing options or necessitate higher deposits. Insurance companies often use credit scores to set premiums for auto and homeowners insurance. A higher score could mean lower premiums, as insurers correlate good credit with fewer claims. This practice underscores the broad impact of credit scores beyond just borrowing scenarios. Employers in certain industries may check your credit score during the hiring process, especially for roles involving financial responsibility. While not a universal practice, a poor credit score can raise concerns about your reliability and decision-making, potentially affecting your job prospects in competitive fields. Understanding the factors that contribute to your credit score is crucial for financial health. These factors include payment history, credit utilization, length of credit history, new credit inquiries, and the mix of credit types. Each plays a vital role in determining your creditworthiness in the eyes of lenders. Payment history is the most significant component, impacting your credit score profoundly. Timely payments signal to creditors that you're a reliable borrower, while missed or late payments can tarnish your creditworthiness. Maintaining a flawless payment record is essential for a healthy credit score. Your credit utilization ratio, the amount of credit you're using versus what's available to you, also influences your score. High utilization can suggest financial distress, potentially lowering your score. Experts recommend keeping this ratio under 30% to portray a controlled and responsible use of credit. The length of your credit history adds depth to your credit report, providing lenders with a longer timeline to assess your financial behavior. Older credit accounts can positively affect your score, assuming they have a history of timely payments and responsible credit management. Lastly, new credit inquiries made by lenders or credit card companies when you apply for credit can temporarily lower your score. While the impact is minor, too many inquiries in a short period can be seen as risky, indicating potential financial instability. Understanding the role of credit mix in a healthy credit score is essential. Lenders and credit bureaus look favorably upon a diverse portfolio of credit accounts, such as mortgages, auto loans, and credit cards. This diversity demonstrates your ability to manage different types of credit responsibly, enhancing your creditworthiness. Having a low credit score can be a significant hindrance. It may result in higher interest rates on loans and credit cards, making borrowing more expensive. Additionally, it could lead to loan and credit application rejections. Over time, this can limit your financial growth and opportunities, making it crucial to address. Improving your payment history is a key strategy for enhancing your credit score. Ensuring timely payments accounts for a substantial portion of your score calculation. Setting up payment reminders or autopay can help maintain punctuality, gradually improving your credit standing and demonstrating financial reliability to lenders. Optimizing your credit utilization ratio is another vital tip. This ratio measures the amount of credit you are using against your available credit limits. Keeping this ratio below 30% is advisable, as it indicates to creditors that you are not overly reliant on credit, which positively impacts your score. Extending your credit history without incurring debt can be achieved through strategic actions. For instance, keeping old credit accounts open can help, as long as they don't tempt unnecessary spending. This lengthens your credit history, an important factor in credit scoring, showing a long-term pattern of responsible credit management. Managing new credit inquiries requires a strategic approach. Frequent applications for new credit can signal financial instability to lenders, adversely affecting your credit score. It's crucial to apply for new credit sparingly and only when necessary, ensuring that each inquiry is justified and likely to result in approval. Diversifying your credit mix can significantly impact your credit score, showcasing your ability to manage various types of credit responsibly. Including a mix of revolving credit and installment loans in your credit portfolio can demonstrate to lenders your reliability as a borrower, potentially improving your creditworthiness and score. Regularly checking your credit report is pivotal for maintaining a healthy credit score. It allows you to identify and rectify any errors or inaccuracies promptly. Discrepancies, such as incorrect account details or fraudulent activities, can negatively influence your score, making it essential to monitor and address these issues immediately. Disputing inaccuracies on your credit report effectively demands a clear and concise approach. Upon spotting any errors, contact the credit bureau in writing, providing evidence to support your claim. This proactive step can help ensure your credit report accurately reflects your financial behavior, positively influencing your credit score. Setting up payment reminders and auto-pay facilities can drastically reduce the risk of missing bill payments, a key factor in maintaining a good credit score. These tools help manage your finances more efficiently, ensuring timely payments and thereby reducing the likelihood of negatively impacting your credit score. Debt consolidation stands as a beacon of hope for those struggling with multiple debts. By combining various debts into a single loan, often with a lower interest rate, individuals can streamline their payments and potentially reduce the total interest paid, thereby improving their credit score through consistent, timely payments. Navigating when to close old accounts versus keeping them open can be tricky. Closing old accounts might shorten your credit history, potentially lowering your score. Conversely, keeping them open, especially if they have a good payment history, can positively affect your credit score by demonstrating long-term financial responsibility. Becoming an authorized user on a responsible account holder's credit card can be a strategic move for credit newcomers. This action allows them to piggyback on the credit history of the primary account holder, often leading to a boost in their own credit score as long as the account remains in good standing. Credit Builder loans emerge as an innovative tool for those looking to improve their credit scores. Unlike traditional loans, these are designed specifically for building credit. The borrowed amount is held by the lender and only released upon the final payment, ensuring that the borrower's on-time payments contribute positively to their credit history. The impact of financial habits on credit scores cannot be overstated. Regular, responsible behaviors like timely bill payments, maintaining low credit balances, and avoiding unnecessary inquiries into one's credit report can significantly enhance one's credit score over time. This disciplined approach paves the way for improved financial health and access to better credit opportunities. Creating a budget is a fundamental step toward debt reduction and credit score improvement. By assessing your income and expenses, you can identify areas for cost-cutting and allocate funds more effectively toward debt repayment. This disciplined approach not only decreases your debt, but also positively influences your credit score over time. Patience and discipline are crucial in the journey of rebuilding your credit score. Improvements don't happen overnight, and it requires a consistent effort in managing your finances responsibly. Staying committed to timely payments, reducing debt, and avoiding new unnecessary credit can gradually enhance your credit score, reflecting your creditworthiness. Marriage introduces a complex dynamic to individual credit scores, as joint financial activities can affect both partners. While individual scores remain separate, joint accounts, loans, or mortgages are reported on both credit histories. It's important to communicate and manage joint finances wisely to support each other's credit score. Myths about credit scores often lead to misunderstandings and mismanagement of credit. For instance, carrying a balance on credit cards does not improve your credit score. Rather, it can incur unnecessary interest. Understanding the truths about how credit scores work empowers individuals to make informed financial decisions. Soft and hard inquiries have distinct impacts on your credit score. Soft inquiries occur when you check your own credit or when a lender pre-approves you without a formal application, and these do not affect your score. Hard inquiries, resulting from actual credit applications, can slightly lower your score temporarily. Understanding the ranges of credit scores is crucial for financial planning and goal setting. These scores, typically ranging from 300 to 850, categorize your creditworthiness, from poor to excellent. A higher score not only opens the door to better interest rates, but also influences lenders' willingness to offer credit. Maintaining a good credit score requires consistent effort and financial discipline. Once you've reached a satisfactory level, it's essential to keep up with payments, manage debt wisely, and avoid unnecessary credit inquiries. Regular monitoring can help you stay on track and address any issues promptly, ensuring your score remains healthy. The allure of quick fixes for poor credit can lead to traps set by credit repair scams. These scams promise unrealistic outcomes and can cost you money and time, with little to no improvement in your score. It's vital to approach credit repair with skepticism and rely on proven strategies. Secured credit cards offer a pathway to rebuilding credit for those starting out or bouncing back from financial setbacks. By requiring a deposit that serves as your credit limit, these cards minimize the lender's risk while allowing you to demonstrate responsible credit usage and gradually improve your score. Student loans play a significant role in your credit score, acting as a double-edged sword. On one hand, timely payments contribute positively to your credit history. On the other, missed payments can severely damage your score. Effective management, including exploring repayment options and refinancing, can help mitigate the impact. Negotiating with creditors can seem daunting, but it's a powerful strategy for managing debt. By approaching creditors with a plan, you might secure lower interest rates or favorable settlements. This not only eases your financial burden, but can also pave the way for a healthier credit score by demonstrating active debt management. Financial literacy is the cornerstone of managing and improving your credit score. Understanding how credit works, the factors affecting it, and strategies for improvement empowers individuals to make informed decisions. This knowledge can lead to better financial habits, which in turn can significantly boost one's credit rating over time. Technology and apps have transformed how we manage our finances, including credit scores. Utilizing these tools can provide real-time insights into your credit health, alert you to potential fraud, and offer tips for improvement. Regularly monitoring your credit score through technology can demystify the process, making it easier to maintain or improve. A high credit score offers long-term benefits that extend beyond low interest rates and loan approval chances. It can lead to significant savings, better housing opportunities, and even lower insurance premiums. Over time, maintaining a high credit score can secure financial stability and provide more freedom in life's major decisions. Maintaining and improving your credit score is an ongoing journey, crucial for reaching life's major milestones. Whether buying a home, financing a car, or securing a loan, a good credit score paves the way. It requires patience, discipline, and a proactive approach to financial management, but the rewards are well worth the effort.